Hope everyone's doing well. This is going to be a video over July the 18th, excuse me. And later on I'll make a video discussing more about always in, buy the close, sell the close, and limit order trading. So I think it's important to really understand breakouts. And that's because if you can understand who's trapped, in other words, limit orders, when they get trapped, you can understand when the market's likely to lead to a breakout. For instance, right here, this is subtle. It doesn't look that strong. But if you really think about what's going on, all the limit order traders that have been buying below bars, making money, on this bar and this bar, they're trapped. That's a strong enough breakout, you're going to get a second leg down. What traders do not know is the second leg going to be something like this and go sideways and reverse up? Or is the second leg going to do something like this? And it just continued lower. So the reality was we had a breakout. It retested the lows and really couldn't give above it. Bears gave up. Bad follow through, but this is a very tight channel ever since here. So even if bulls buy here, they got a strong bar. And I think this was a low probability event. And the reason I think that is, for one, we got a measured move all the way down to there, which makes me think it's low probability. But also, it trapped a lot of traders. This was a reasonable buy. If you're quick to make decisions, it's certainly reasonable. The entry bar was strong, and then on the bar, completely reversed the move and closed far below. So it's a sell to close bar, and traders will sell this. But anyways, I'll talk more about that later on. So overall, today, we had a gap up, sideways to the moving average, tried to form a wedge. You can call it a triangle here, broke to the upside, and had a pullback that was endless, and then we got a bear breakout of this bull flag that led to several legs down. And what's important overall is to understand when the market transitioned from this, which was a trading range, to this, which is a trend. One way you do that is being aware of buy the close, sell the close. You cannot have a strong limit order market and a strong buy the close, sell the close market, because you can't have a strong trending market be a strong limit order market. And that sounds simple, but it's really important to understand that. For example, this right here is a terrible buy the close, sell the close market. And what I mean is, here, this is good buy the close, but it led to sideways. Most traders that bought would scale in, get out around break even, sell the close, but not clearly sell the close, got a second leg down. And even if you sell this close, you're disappointed, so most traders get out break even, and you're not going to sell this close. What about buying this close up here? Well, it's the third push up, so it increases the risk of a two-legged pullback, and this is bad follow through. What about selling this close? Again, moving average is flat, bottom of the range, we're low in the range down here. You may just get a second leg down and that's it. But again, I'll talk more about that. On the open, as I said a few minutes ago, we gapped up. Probably always in long, but most traders want consecutive bull bars closing on their high, especially with the moving average being far away. If they start to get bear bars, they will become worried that they're buying too high and that the market's expensive. Therefore, a lot of bulls may wait and buy a pullback. It's a reasonable buy. Traders are going to want a strong entry bar if they do buy. They want the move to be quick because they're paying far above average price. The moving average is average. You hear Al talk about that all the time. They're paying far above it. And they got bad follow through here. So a lot of bulls would be interested in, they'd probably look to scalp out. They bought, this is disappointing, they may get out quickly. And then you get a high one buy, even more disappointing. A lot of bulls would take profits up here. Aggressive bears would sell. which is why bulls, bad high one, bears will sell and went outside down. Some bears will sell this close, bottom of the range, may test the moving average, but if you do sell and you're quick, it's probably a reasonable trade. But again, bad follow through here. So, and even here, let me get a sip of water. We have a bear bar closing at its midpoint. So if you're wanting to trade always in and you're looking for a swing, this is disappointing. This is limit order trading. Bulls buy below, they buy more here. Bears, they sell above bars, sell this high, sell above here, sell here, and scalp out. They weren't aggressively or eager to sell this close. Whereas on the prior day, we had, not really great here either, but a few bull bars they bought. Let me go back to, there we go. So even here, big bear bar, but doji, it's a sign of limit order traders. Bears that sold, they're disappointed. They're scalping out of longs. Bulls, they're buying knowing that the bears are scalping out, which creates limit order trading. It's a micro channel down. Odds are you're going to get a second leg down. We have a wedge, 1, 2, 3, so make it a few legs up. There's a few legs up. Now we have a low too short, but it triggered below the bull bar, probably buyers below. Also really close to the moving average. Probably going to go sideways here. It's not clearly always in long, it's not clearly always in short. Where if there's one thing we're confident in, it's that it's going to reach the moving average. So bear bar closing above its midpoint, probably again buyers below. They bought at the moving average. They're buying these lows. So limit order traders are doing really well buying below bars and selling above bars, which means stop orders are not doing well. Stop entry buy here, but do you really want to buy a bull bar that didn't close on its midpoint or didn't close on its high after a 4-bar micro channel? You probably don't. Bull bar closing at its midpoint, probably going to go more sideways. And, again, we could easily fall below these lows and form a more clear wedge. Disappointing. So bulls, they bought this close. Disappointed, they make it out break even, which is what happened right there. Let me zoom in a little. That's important to see. So where'd that go? It also happened right there. Bulls bought, disappointed, tried to get out the high close. So bulls bought, disappointed, and price went one tick above, turned down. Probably buyers below. Again, it's been a limit order market all day. So now you have a triangle, 1, 2, 3, 1, 2, 3. Bulls will buy, stop below, betting that the market has a few legs up and that it may test the open of the day, which is right here. Disappointing entry bar. Some bulls will be interested in getting out at break even, but the bears, they had a couple chances down. The bulls will probably have a couple attempts up, and the bulls got a breakout. Probably always in long, but again, you're breaking above these highs at the open of the day. So the bulls have a breakout. What's the follow through going to look like? And it's disappointing. It's a bear bar, but it's following a micro channel, probably buyers below, and at least a second leg up. So the bulls that buy here can probably scale in or get out at break even, which it allowed them to get out break even. Now they have a second entry short, so increases the chances of a sell-off, but again, channel's still pretty tight. The doji bar, bulls bought this close, disappointed, getting out break even, trying to get out this high close up here. Bulls, they bought this low right here, scaled and lowered, able to get out break even. So you can call it a second entry buy, but it's a tight trading range. You can call it a wedge, 1, 2, 3, above the moving average. Not a good buy. Didn't trigger. It's also forming a very tight micro channel, which increases the odds that the first versal up will fail. And what you have to be worried about is this. So you have a wedge, 1, 2, 3, 1, 2, 3, micro channel, bear breakout below a wedge. In general, 50-50 chance that it fails, 50-50 chance that you do get the breakout and a measure move down from here to here. Strong breakout bar, well, breakout bar, strong follow through bar, 3 consecutive bear bars, probably going to get a second leg down. So what does that mean? That means traders are going to be willing to sell this close, and if the follow through is bad, they'll get out break even. So they'll sell this close. If the follow through is really, really bad, they'll get out at the high. If it's not so bad, maybe something like this, they may consider scaling in. They may just place a limit order back at the low close to exit. And if it's weak enough, they'll hold for a second leg down. They're obviously hoping that it's a very big bear bar closing down here. Bear bar closing around its midpoint. It's follow through. It's 4 consecutive bear bars, probably at least second leg down. Bull bar closing on its high. However, after that many bear bars, it's probably going to lead to a pullback and a second leg down, more so than a successful reversal, at least without a micro double bottom. So why do you need a micro double bottom? Well, it's what I've been talking about. Bears sell this close. It's a retest of a breakout. So bulls buy the close, disappointed, it retests, turns down. That means the bulls that bought were able to get out break even over here, which led to the market turning down. So on some time frame, some bears sold the slow tick. They'll scale in higher, and then right here it allows them to get out break even, which creates a double bottom. Low one short, probably buyers below for a scalp, but again, you have to be very careful about that because it might be sell the close here, which increases the risk of a second leg down. You have a doji bar, but it's in a very tight channel since here, and you have to ask yourself, if the bulls were strong, why didn't they close on its high? Why does it look like that? And then you get this. And really, I don't think that this should not have happened. And what I really mean by that is the odds favored a second leg and then a reversal up. Nobody knew the breakout would be this surprising and lead to all of this. Or maybe, the bears get a second leg and the market reverses here. But anyways, so bears, they were willing to sell more at the lows, which is a sign of strength and not a sign of profit taking. This was minor profit taking and maybe some bulls buying for a quick scalp. This is a sign of more selling, which means probably lower prices, probably a strong enough bar that it might lead to a second leg, which makes buying above this bar difficult. But if a trader did buy and they get the decent follow-through bar, a lot of bulls that bought this would be quick. They recognize the channel's tight. They want the market to go up quickly. If it started to turn down like that, they'd be quick to just exit, maybe at the low of this bar. Big bear breakout, probably surprise. Follow-through bar, probably going lower. It is sell the close, but it's hard to do when you might get a big bull bar. The next bar might be a bull bar closing on its high, but traders will sell, betting that you won't get that bull bar. And 3 consecutive bear bars, probably going lower, probably at least second leg down, and because of that, traders are selling aggressively. Some bears would not be willing to sell this close because of the risk of getting maybe like a bull inside bar, but when they see this bar, 3 consecutive bear bars, they know that a lot of bulls may give up here and lead to a small second leg down. So bull bar, but again, still sell the close. This bar is climactic. So again, probably sellers above and sellers at the close, so sellers above, and we'll probably have to retest this close. But we could easily get up to here before we do that. And big bear breakout bar. Again, still sell the close. Hard to do though. It's consecutive sell climaxes. 1, 2, 3, 4. Doji bar, disappointing. Probably, some bears will buy back shorts at this close. Disappointed here, and they'll look to sell higher. Some aggressive bulls will buy here, but that's tough to do. I mean, that's a pretty strong micro channel, and you've got to be good at managing the trade. Inside bar, and then you have outside up bar. Some bulls will buy above, stop below, but again, they need a strong upside breakout. So if they do buy, they've got to be quick to make decisions. Big bull bar, and boom. When they see that, a lot of bulls will get out below. It's a second entry short, low 1, low 2. Bears, they sold this close, disappointed. Some got out break even, some got out above. Those bears are sell to close bears. They're always in traders, always in bears. They've got to sell again, and they'll probably put a stop up here, betting that you get a second leg down, which strong breakout, probably going a little bit lower. Probably buyers somewhere down here though. So a bear can sell the close, but again, it's difficult to do. So bull bar, but after this many bear bars, these two bear bars may get a second leg down, which they got. Doji bar, but again, channel down's tight. But it is possible that a bear that sold this close would be disappointed and they'd get out, but it's probably better to wait and see if you get a strong bull bar closing on its high. Another bear bar closed at its midpoint, a follow through bar. So again, even same thing here. Some bears will buy this close, some bulls will buy this close, betting that the bears, they're front running. They want to see a bull bar like this. They'll buy this close, hoping to see a bull bar. And when they get this, it's possible that they give up on the trade, betting and look to buy again lower. Some bulls will just use a wide stop because of this stop entry up here. Disappointing bar. Bears that are selling closes, it's a consecutive sell climaxes. You can call it a wedge, 1, 2, 3, or 1, 2, 3, and a second leg down. It's also a micro double bottom with this tail. A lot of bears will get out above this bar and look to sell again higher. Big bull bar, and then we got a bear bar, but closing above its midpoint, probably a second leg up, which we got. And then we got a bear bar, so it's a wedge. 1, pull back, 2, pull back, 3. It's a wedge. Bears will sell below, stop up there, betting that the bears will get a second leg down, which they got. Strong bear bar, probably going a little bit lower. It's sell to close, but again, it's really tough to sell closes like this, especially when you're this far above the moving average. But traders will do it until it doesn't work. And they got a big bear bar, so sell to close. Those bears would take profits. And they got another sell to close bar. So this is why traders sell to close right here. It's a good example. It just keeps going down. They sell, and they can hold until there's a bull bar, and they get out maybe a couple points above that bar. They can continue to sell, get out of the trade, sell to close. They're disappointed, so what are they going to do? Well, whenever they see a doji, sell to close market, and they see a weak bar, it's a sign that the market may start to go sideways. If it's going to go sideways, that means it could go up, which means a lot of bears will be quick to take profits and take profits on the strength, which is why this bar opened on its high and closed on its low. This is the strongest looking bar out of all of these. I get it, this bar's bigger, but here's the breakout, here's a follow through bar, here's another bar. So if your moves tend to get weaker as they progress. So this is a buy vacuum, and there's going to be no one left to short here, so a lot of traders will buy this close, which is why that happened. But even the bulls that bought this close, well, I guess I forget, it's late in the day, it rallied into the close. But the point is, traders sell the close because they know the probability is high that you're going to get a second leg down. So let me just, that's a lot to think about. Let me talk about always in for a minute. Because again, the reason I keep talking about sell the close, buy the close is if you know the market's not in a buy the close or sell the close market, it's a limit order market. And you can buy below bars, sell above bars, and scalp. a lot. The tricky part is being able to be quick to get out when you think the market might be a buy the close market, and then figuring out how to get in that direction. And it's really hard. It can be really hard to do that, where you buy this close, you're buying below bars. You buy this low, make money. You buy this low, make money. You buy this low, make money. Buy here, make money. And you're going to do the same thing. And then you get this bar, and then you get this bar. It can be really, really difficult to be quick to get out. And normally, you're buying this low, you scale in lower, you've increased your position size. So you're taking a full size loss when all of these were small profits. So you have to be very quick to get out. And then the worst thing one can do is hold and get out way down here. So anyways, let me talk about always in for a second. I think that's the single most important thing people can learn how to trade or how to watch is always in swing trading. So on the open, always in long, probably based upon the gap. So the first reasonable buy is above this bar. Traders will buy, stop down there. Weak follow through, but no reason to sell below, no reason to get out. Doji bar, a lot of bears would get out below this bar. Quicker traders would get out above, as I stated earlier, or as the market went outside down below this bar. If not, you get out below. It's an aggressive sell below, but some bears will do it. Weak follow through, but continue to go lower. Always in bears, they can get out above. It's not clearly always in short, so they will be quicker to get out. And that's another thing. The stronger the move, the more willing traders are to hold the move. The weaker the move, in other words, the more trading range price action one has, or the market has, the less willing they are to give the market chances. So it's kind of like this. Traders are happy to give the market several chances on a reversal because this is so strong, the market's probably going to have to go sideways for several bars. Here, it's not strong. It wouldn't take much to get a reversal up. So bulls, double bottom, it's a wedge. Some bulls will buy above, stop down here. But what do they do right there? Hard to say. Most traders wouldn't short at the moving average, so not really an ideal sell. Bulls probably buy above that, stop down here. Probably always in short for a second leg. Some bears will get out, some bulls would get out below this bar. And, this is what makes it difficult. So if you get out right there, not a great buy above, didn't trigger, plus it's a micro channel. Still not a great buy. It's a however many bar micro channel from here to here. So might get a second leg. Low one short, bear bar, follow through bar. Probably always in short, traders will sell the close. And some bears may give up 3, 4, or 5 points above this bear bar, but are never triggered. Bears probably get out above this bar, aggressive bulls buy, and big bear bar, so those bulls would have gotten stopped out or they would have gotten out quickly on the way down. Probably strong enough bear bar for at least a couple legs down, and it's probably always in short. Higher probability to wait for follow through, which was here, so sell the close, stop up there, and no reason to get out. Some bulls would get out a couple ticks above, but even then, not clearly going to reverse up, so one can stay short. Second entry buy, micro double bottom, bulls would get out. Bears get out, aggressive bulls buy, but then they got a second entry short, so those aggressive bulls get out for a small loss. Bears have to sell again. Bull bar, you can call it a micro double bottom with here and here, but after this many bear bars, might get a second leg down, but it's so always in bears, probably get out above this bar. And if they did, they've got to look to get short again. It's hard to sell a breakout to a new low after you see this because the odds favor some type of wedge. But and they got a bull bar, and the market bear bar below it, closing above its midpoint, and then you get a close like that. So in theory, bears will sell, but I think it's really hard if you're an always-in trader. It's easier if one can sell and be quick to make decisions. It's hard to just sell and put a stop up here, because there's too much risk that you're going to get a deep pullback like that. So if one is, if there is a situation like this and it's always in, and one's trying to trade always in, it's probably better. You don't know how much further it's going to go. Probably better to look to sell some sort of complex pullback closer to the moving average, maybe a wedge top, double top, and if it keeps selling off, just let it go. But the bears that sold there, they might be disappointed here and just get out at break even and look to sell again. So you have a wedge, 1, 2, 3. Bears will sell, stop up there. Follow through bar, again, always in short. No reason to get out. And like I said a minute ago, a lot of bears will take profits on this bar. It's best looking bar. Big outside up bar. So if a bear was short, they'd get out above the bar, certainly, or get out a couple points above, and the market rallied like that. But this kind of day, this can be a tricky, I think it's always tricky when you get a trading range open and you get a move that looks like this. Because this really, if you take the high of this bar to the low down here, we doubled the range, which is pretty uncommon. Traders really like to see, I think it's easier, which is why you had such a strong sell-off. It's easier when you see something like this. Consecutive bull bars, 70% chance you're going to get a measured move up. And as far as best trades or reasonable trades, this is pretty difficult in the open. If you're buying this bar, I think most traders that truly buy above it know that the market's probably not going to have a trend from the open. Therefore, they're naturally looking for reasons for it to fail, which keeps them from losing at least that much. Maybe buy above that bar, stop below here, and just hold for a couple hours. Maybe buy here, stop below. Or it's probably best to wait for this, sell the close, stop up here, and you get out maybe above this bar. But it's hard to sell again on this close. And then maybe selling that wedge, but again, that's hard to do as well. So, hope this video helps.